Friday, September 29th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at why, in my opinion, there's a 3 in 4 chance or 75% chance that the U.S. economy will be in recession before year end. Yes, before the end of 2023, not 2024. Before we do, though, let's jump back across the pond to the UK. We had some economic data come out early this morning, GDP. And some of you have probably heard me talking about how they calculate GDP, that they add government spending to GDP and they deflate it with whatever rate of inflation they want to do it to make the growth looks better. We know that the ONS, Office of National Statistics, they tinkered with the CPI going back to 1949 from May last year. So what the government's calculating as inflation is probably 1% lower than it should be. But be as it may, the Telegraph is cheerleading, of course. They're saying UK economy recovers stronger than France and Germany and boost for Sunak. Yeah, I'm sure that people out there striking and wanting better pay or struggling to buy food or will be struggling to heat their home this winter. Yeah, they're going to be like jumping for joy about that number. So what was the number? Well, let's quickly have a look at it. GDP grew by 0.6%. Yes, that's for the whole year from the second quarter. That's an annualized number up until the second quarter, 0.6%. That's almost, that's not even 1%. So how that can be a good economy, I don't know. And why is this happening? Well, I've got a couple of opinions and reasons why. The first one is that the era of low rates, even negative real rates, that has encouraged investment in speculation, in financialization, not in the real economy. So the other thing is our debts are too big, not just public, but consumer debt, and rates are going up. So things are not going to get any better. And the other thing I saw the other day that really doesn't help, and it looks like the country's going the wrong way, is this survey here that came out recently. It says UK public support for big government hits record high. Voters want state to be responsible for controlling prices and reducing inequality. So that's not good. Pause the video here to have a look. It's pretty sad that people are clamoring for more and more government. But I think I know why, and it's all about psyops. They create a huge crisis that makes people want something that it's like a nudge. And these people are good. And why are they doing that, the powers that be? Well, because they don't want you self-sufficient, self-reliant. Because if everyone's doing well and independent, self-reliant, doesn't need government, they can't bring in their one world government, right? So it says here, the researchers said the resilient support for higher spending and taxes could signal a permanent shift in taxpayers' outlook. The survey's findings suggested COVID might have led voters to reset expectations on the role of government at a higher level than in the past, thereby potentially leaving a legacy of greater support for big government than has been the case, they wrote. So, yeah, that's what it was all about, in my opinion, the bigger picture. And that's what World War I and World War II were all about. And Norman Dodd, he was the researcher for the Reese Committee into the tax-free foundations in the 50s in the States, and the Carnegie Endowment for International Peace, or it could have been the Ford Foundation, one of those two. When they were founded in 1909, they said, what's the best way to change the way society thinks and the way people act? And they're talking about the United States, but you can apply it to the UK. And the conclusion was that barring a war, a major war, it would take very long time to like change people's perceptions. So I think that was one of the major goals, COVID and the lockdowns and everything, to make people clamor for even more big government. So why am I talking about that? Well, because it's not going to improve the growth of our economy. Yes, they'll tinker with it, but with people wanting so much big government, you know, I don't think we have much hope. Unless, of course, everything implodes and collapses and they can't really put those plans through, because you need money to do that. And if the money is bad, if the money collapses, that's the only hope we got. So back to the U.S. economy. And I'm going to show you a chart here of the 2s, 10s yield spread. Well, that's the difference between the spread in the U.S. 2-year note and the 10-year note, the yields. And why is this so important to trying to forecast recessions or even a big crisis? Well, usually banks, they borrow short-term rates. They borrow like over a month or 3 months, and then they lend out longer term. And that keeps the economy going, especially in a credit-based economy. So there's a positive carry for banks. So usually the yield curve normally is upward sloping, mainly because lenders want more of a return on their capital if they're going to lend capital for a longer period of time, because a lot more could happen over a long period of time. It's less risky to lend money for a day than it is for 1 year, or it's less risky to lend money for a year than 10 years. But eventually, when the economy heats up in the central banking system that we have, the central bank changes policy in the short-term rates, and those short-term rates rise. And a lot of times, the longer-term rate doesn't rise as quickly. And that's where you get an inversion of the yield curve. So people are getting less to lend money for 10 years than they are to lend money for 2 years. And that's when the 2s, 10s yield spread inverts. So the 2s, 10s yield spread is just taking the 10-year yield and subtracting the 2-year yield from it. And usually, most of the time, it's positive. So what that does, of course, to the economy is slow it down when the yield curve is inverted, because banks are not going to lend as much to the real economy, and that's why it triggers recessions. So we heard recently from Austin Goolsbee. He's now on the board of the Federal Reserve, I think. But he used to work, I think, for the Obama administration anyway. He said the other day, I think it was yesterday, it looks like we've succeeded, by we he means the Federal Reserve, in bringing down inflation, not creating a crisis. And he said that yesterday, and I think he's being a bit premature, so I'll show you why. I've done a little bit of research here, and I've only gone back to the late 80s, but as you can see, we've had 4 recessions since the late 80s. There's one in 89 to, I think it was 1992. That was a relatively long depression. But as you can see here, the red line, the horizontal red line, that's when the yield spread is at 0. So anything below that is negative. and you can see that back in before that recession, it went negative. And then when the curve re-steepened and became positive again, the recession began. And it was a relatively long recession compared to all the other three that we've had. It's actually the longest one. And I remember rates went up to 7 or 8% in the long-term yields. And yeah, recession. There's a recession, as you can see here, 4 months after the bottom in that yield spread. So the recession started, 4 months after the spread went the most negative. And then we come forward to the dot-com bubble recession in 01 to 02, I think it was, or and it wasn't a very long recession, as you can see. But the yield curve also there bottomed 4 months, before the recession started. So there you go, 4 months. Recession wasn't that long, as you can see. And every time there's like a crisis, of course, when there's a recession. In '89, early '90s, there was a savings and loans debacle, of course. I think it cost hundreds of billions to the taxpayer back then already. So we move forward to the 07-08 crisis, which was a huge crisis, of course. And that's why I said only 3 in 4 chance, because during that recession, the yield curve bottomed, the 2s-10s spread bottomed 9 months before they declared the recession. So, and then the recession usually begins after the curve goes positive. That's the other thing as well, which actually I heard from what's his name again? I forgot. And if I remember, I'm going to put it below in the video when I edit it. But he was the one who said it on the Greg Hunter show, that yes, a negative or inverted yield curve points to recession, but the recession usually starts when it go to zero. But what I found as well is that it's usually 4 months after the yield curve bottoms. And the same thing happened in the 2020 recession. The yield curve bottomed 4 months before the recession was officially declared, as you can see here. I think the recession only lasted from January 2020 to the third quarter of 2020. And back then, the yield curve barely went negative, and everyone was saying, oh, this time it's different. The yield curve doesn't matter, but it did matter. So here we are in the present day, and you can see that the yield curve bottomed in July this year. So yeah, the 2s-10s. You could argue that it's not the bottom, but look at how much it's rebounded. In my opinion, I'll go out on a limb and say that it's bottomed. So if you go 4 months from July, you get to November, and that's why I said there's a 3 in 4 chance that we will have a recession before the end of the year. Does that mean that there's a 1 in 4 chance there won't be a recession? No, there's a 1 in 4 chance that the recession will probably be will only happen sometime in the beginning of the spring next year. So either way, I think we will be in a recession. So now you're probably asking, so what crisis is going to trigger this? Well, go back to March this year, and what happened? Well, it was a banking crisis because of the bond market. Because treasury yields are going up. All bonds are going down in value and their yields are going up. And it hurts banks' balance sheets. And it's a little bit like the subprime crisis. We started seeing the subprime lenders go bust beginning or spring of 07. And it wasn't until late 2008 and 2009 that everything hit the fan. So if I had to guess, it would be something related to the banking sector. And yesterday, of course, with Rafi Farber, I spoke about that. We spoke about the banking sector not being out of the woods. Could it be also a sovereign debt crisis, like a U.S. sovereign debt crisis? Yes, and the banks would probably trigger that. So that's the way I see it. Now let's quickly look at where the markets are this morning. It's 8:26 a.m. London time. So we've got spot gold at 1871. That's up $7 or 1/3%. Silver is at 23.04. That's up 43 cents or just under 2%. High's been 10, low's been 58. The low in gold has been 62, and we're right near the high right now. Stock market has kind of rebounded for now. Right now, the Dow futures is up 127 points. The NASDAQ 100 future is up 81, and the S&P 500 is up 15. The currencies as well versus the dollar, they rebounded yesterday. They're continuing to rebound here. So we're seeing a correction in the dollar index at least. The pound is up 1/3 at 122.40. The euro is up 1/4%, just below 106. And the dollar is down 0.5% versus the yen at 148.66. The dollar is down 0.2 versus the yuan at 728. The dollar is up a bit versus the ruble. Dollar's trading around 97 rubles. Let's check the other currencies here. Start with the Aussie dollar. Aussie dollar is up 0.8% at 64.80. The Canadian dollar is down 1/4% at 134.52. And the Kiwi dollar actually is up 1.1%, and it's trading above 60 at 60.28. To the commodities, we got WTI crude up 1/4% at 91.15. Brent is up 0.1 at 93.14. Platinum, that's up $9 or 1%, trading around 919. High-grade copper is up over 1%, trading at 375.67. Let's quickly check the bond market. The 10-year yield, yeah, that has come off quite a bit from the highs yesterday. We got up to around 466. You can see how quickly it moved after we broke that 433. A matter of days, we went up 30 basis points, but it has reversed, and right now we're at 454. It's down about 6 basis points. The 2-year as well is down 3.4. So I think that yield spread is around 48, the 2s, but I think it's going to continue to narrow or steepen. What that means is the 10-year will go up quicker than the 2-year, or the 2-year might drop even if the 10-year doesn't move and match it at that level. Why would that do that? Well, because the market might discount the chance that the Fed will come in and cut short-term rates, and that would greatly impact the 2-year. What about in the UK? Well, we heard yesterday that some mortgage lenders cut mortgage rates, but and it came out in the news, but yesterday at one point, yields in the UK government bond market were up like 20 basis points. They have come off since then. The 2-year got back up above 5, and it's now at 494 though. They've got it under control for the moment. The 30-year got above 5, which is significant, but right now it's back to 491. So with that, I'm gonna wish you all a very good day and a very good weekend. Take care. Bye.